Good evening, everyone. Welcome to this evening's lecture by Mr. J.C. D. Swan. This is the first of two lectures from him, and the second lecture is scheduled for March 29th at the same time, 8 o'clock in the evening. Thank you for joining us tonight. My name is Srish Chatterjee. I am from the Faculty of Finance and Business Economics, and I'm grateful to the school and the university for the opportunity to serve also as the Gabelli Chair of Global Security Analysis. Before we start, I would like to say that 2020 marked 100 years of purpose-driven business education at Fordham. Tonight's lecture is a testimony to that purpose, a testimony also to the social values that the Gabelli School stands for, and the Jesuit values that are the hallmarks of Fordham's distinctive heritage. We are very grateful to J.C. D. Swan for giving us an opportunity to learn from his valuable perspectives on Wall Street, both from the inside as a partner of a financial firm, and also from the outside through the lens of ethics and social responsibility. Mr. D. Swan is a lecturer in the economics department at Princeton University, where he's affiliated with the Bendheim Center for Finance. He teaches courses on ethics in finance and on Asian capital markets to undergraduate and graduate students. He also teaches at the Judge Business School at the University of Cambridge. In the past, he has taught at Yale University, Hong Kong University of Science and Technology, and Cheung Kong Business School in Beijing. Separately, J.C. is a partner at Cornwall Capital, which is an investment fund based in New York. Prior to Cornwall, he was a senior advisor on China at a global macro fund and an investment professional at an Asia-dedicated hedge fund. Prior to that, he also worked at McKinsey & Company. J.C. D. Swan received his BA from Yale University in political science, an MPhil in international relations from the University of Cambridge, and a master in public policy from Harvard University's Kennedy School. He's a member of the Council on Foreign Relations and an associate fellow of Ezra Stiles College at Yale University. He's the author of Seeking Virtue in Finance, Contributing to Society in a Conflicted Industry, a book that was recently published by the Cambridge University Press. The format for this evening's lecture is fairly straightforward. First, Mr. D. Swan will speak for about 45 minutes or so, and then we will have the Q&A session from the audience. Please put your questions in the Q&A box on Zoom. I will act as the moderator during the Q&A session. So with that, now over to our guest, J.C. D. Swan. And J.C., thanks again.
Great. Thanks so much, Professor Chatterjee, for having me here. It's so I'm really excited about doing this at Fordham because of Fordham's historical focus on ethics and on values. So I'm very grateful, Srish, that you invited me to give these two lectures with some students. So let me give you a little bit of background for my research and the book that I just published. And the background here is, as Professor Chatterjee mentioned, so I divide my time between teaching and working in an investment fund. But my entry point into the investment world was a little unusual. I think most people that work in the investment world tend to be really passionate about markets. If they work on the public security side, they tend to be generally very motivated by investment returns and the whole game of investing. I've never been so interested in that. I have more of an intellectual interest in finance and specifically in institutional investment. And that's because I studied public policy and economic development, and I came to the investment world with a view that finance is a force for good, and that it can be it could have a tremendous impact, particularly in emerging markets, if you were to deploy invested capital there. So after some years working in management consulting, I moved to the buy side, and I wanted to test out that theory that it can be helpful to emerging markets by being part of that process of deploying capital in emerging markets. And I joined so it was a long-short equity fund dedicated to Asia. So based in New York City, but I was really commuting to Asia. It was a fantastic experience. I did that for about 4 years. But it really took me about 1 week to realize that I would have literally zero impact on these economies, because we were essentially trading between each other. We were buying and selling liquid securities with other hedge funds, other institutional investors. And at the end of the day, it didn't really have much impact on these economies. And it really spurred me to think about, what is it about finance that is a force for good? What is it about the subsector of finance that is professional investments that is a force for good? And so I just wanted to be more thoughtful about it. And I always had a little bit of an academic bent. So that's when I started my teaching career about 12 years ago. And I created a course on ethics in finance, really to understand these issues better for myself, and of course, to try to move forward that research and to try to share it with students. And I remember a couple things that happened early on. One is that it became very clear to me that a lot of my students, so whether it was in my ethics course or so I teach this other course on Asian economies and capital markets, a lot of my students, of course, are interested in working in finance. And it became very clear early on that a lot of my students were deeply concerned about, so first of all, very interested in going into finance, but deeply concerned about being corrupted the moment they walk into Goldman Sachs, Citadel, Blackstone, you name it, right? Financial institution. And so that concern seems to have grown deeper after the global financial crisis. So that was something that was very striking to me. The other thing that shaped my thinking very early on is that actually the first year I taught my ethics and finance class, halfway through the semester, one of my students came to me and said, why is it, so she asked me, why is it that when we study ethics and finance, we tend to focus on bad behavior? A lot of the stories are about conflicted behavior, bad decisions, bad outcomes, and people that could have essentially done better in fulfilling their roles in society. And she said, why is it that we never study constructive behavior? Why is it that we never study inspiring people? And I thought about it and I thought, of course, why is it that we don't look at role models and study them in some way, shape, or form? So I went out to try to look for that literature. I couldn't find it. So I ended up making it a research project for myself, and I ended up making it a part of that class. And the idea was that, so I essentially set out to identify remarkable individuals. But to be clear, I wasn't looking for altruistic individuals, because it's very hard to relate to altruistic individuals. What I wanted to find were examples that we could relate to and that we could try to emulate. So these are people that so they work in the industry in all sorts of corners of the industry and in different sectors of finance, who are self-interested, many of them ambitious, most of them successful, each in their own way. But the important thing was I wanted to find people that were able to manage their self-interest with the collective interest, despite the constant pressure that you have in the industry to conform to norms. And the norms tend to be anchored on short-term profit maximization, right? So I wanted to find virtue in the industry. And one way to think about virtue in the industry is people who were able to live and live up to their humanistic values and to contribute to society, despite the fact that the industry is, in many ways, I mean, we're often conflicted. There are lots of conflicts of interest in the industry, but they were able to be thoughtful about it and not do it in a way also that, made them shunned from the industry after 2 weeks on the job, right? I mean, so it was important to also to look at people and to find people who were successful. And so that's what I've done is look at role models and try to learn from them. Now, just to be clear, and I think it's important in terms of setting the tone, my fundamental belief is that finance is a force for good. That it's a tremendous factor in helping foster prosperity, in helping develop economic welfare, and and the research, a lot of research supports that. I think when I studied economic development in the 1990s, we frankly did not pay much attention to finance at all. Like, we thought of it as the plumbing, but it's really in the 90s that you started seeing research showing the beneficial impact of the development of the financial system on economic development. And it tends to promote growth. It tends to foster innovation. It tends to be helpful to entrepreneurship. It tends to improve corporate governance. So there are all sorts of things that are beneficial. By the same token, it's hard to look at the industry today and not come away with the conclusion that there is certainly a significant part of the industry that seems to have, I wouldn't say lost its way, but that is not so clearly helpful to its customers, but more importantly, to the common good, right? And in some ways, it feels like part of the industry has moved away, one, from its client-serving mission, and two, importantly, from its singular focus on supporting the real economy. A lot of finance now is self-regarding. It's a lot of transactions between financial actors that at the end of the day don't seem to be supporting real economic activities. And so now there are all sorts of reasons for this, and we can delve into them during the Q&A, but an important part of this is structural. There's been a massive change taking place over the last 4 decades on Wall Street. And starting with DLJ in the early 1970s, most of our large financial institutions went public. They used to be private partnerships. And when you're in a private partnership, it tends to induce a certain type of behavior that is very responsible and that is inherently conservative because you're on the hook, right? If you're going to generate losses, it's your money that's at stake. And if there's a hole in the balance sheet, you're going to need to bring up your own savings to fill it. Now, when you move to a structure that's a publicly listed company, the stakes are very different, the incentives are very different, and it tends to spur much more aggressive behavior. And you can see how over the decades, a lot of the financial institutions ended up being a lot more leveraged, ended up taking a lot more risk. And there's an asymmetry that seems to pervade these structures in the sense that there's a lot of upside for private participants, so for the senior management of financial institutions. But when things go south and these institutions blow up, the cost of that blow up tends to be borne by society, right? So that's one of the important structural changes that's taken place over the years, and that has changed behavior on Wall Street. And so that's one of the reasons why we might see more conflicted behavior and potentially like more bad decision in terms of the collective interest. So going back to my core research and to what I was trying to encapsulate in the book is, might we be able to learn from these role models? And so my point here is that it's not an end-all be-all solution to the industry, right? I think regulation is critical, and that's the most important. But essentially, at the end of the day, it's a mosaic of pressure points that are going to spur the industry to improve itself. Part of it is going to be shareholder activism, which has developed into an incredibly potent force. But there's a part of it which has to come from within the industry. And it's kind of this agent-based approach, which is, when you're in the industry, how do you think about contributing to society? How do you think about what might constitute virtuous behavior? And that's what I tried to tease out from the study of these individuals. And so in the book, I end up writing about, I think, 60 individuals and firms as examples of that. And from that analysis, I teased out a simple framework that provides goalposts as to what might constitute virtuous behavior. So let me walk you through it in an abbreviated fashion, and then we can have a discussion on any part of this. But essentially, there are 4 pillars. So I'll just go quickly over the 4 pillars. But for each pillar, what I might do is bring up 1 or 2 role models so I can illustrate what I mean by that particular pillar. And let me start with the first pillar, arguably the most important, which is to serve your customers with your customers' interests in mind as a priority, right? So serving their interests faithfully, even when no one is looking. And that's the important piece here, because in finance, it turns out it's often the case that no one is looking. Because finance is complex, it's opaque, and there's often a lot of asymmetry of information between the service provider and its clients, particularly if it's a retail transaction. And so as a result, there are a lot of opportunities for financial professionals to self-serve. And so this idea of serving the customers faithfully, it sounds banal, but in reality, it's incredibly important to actually think real hard about whether you're serving the customer's interest or not. And it's the most important because that's the fundamental professional mandate of finance professionals. We're in the business of serving customers. Whether you're a retail banker and you're a teller or a branch manager, whether you're in insurance and an underwriter, and whether you're an investment professional and your customers in this case are your own investors, right? So for me, my customers as a hedge fund professional are the limited partners that invested in our fund and we're deploying their capital, right? So the question is, how do you think about serving your customers' interests faithfully? Well, for one thing, you need to think hard about, are there cognitive biases that are clouding your judgment? Because that's one pervasive challenge throughout the industry, which is that because the industry is complex, because it's opaque, and because there's a ton of pressure on individuals to perform, because there's often strong incentives, strong monetary, financial incentives to perform well, and you're always part of a team, so you're going to get pressure from your managers, but also your teammates to perform. And the question is, the issue is that you often become oblivious to the moral dimension of your day-to-day decisions. Because if finance ends up being a game, it has its own rules. You never question these rules. And as a result, you kind of are oblivious to any ramifications, any moral ramifications of your decisions, right? So what are examples of particularly virtuous conduct here? If you want to look at saintly or near saintly conduct, you might point out Jack Bogle, right? And Jack Bogle was the founder of Vanguard. Vanguard is an asset management firm that he created in 1975 or so. And I would argue, he's had more positive impact on the industry and created more social value than anyone else I can think of in the finance industry over the past few decades. And what he did was he was instrumental in helping along a revolution, which has been the shift from active asset management to passive asset management. And now for individual savers, we have known since the early 1970s that they're much better off putting their savings or the bulk of their savings in index funds because they don't pay any fees or very, very little fees to the street by doing that. And on average, they tend to outperform something like 90% of actively managed funds as a result. But the active managed fund industry, so say the mutual fund industry for retail savers, has been thriving, right? And it's only in recent years that you've seen this massive shift where people are finally putting their assets or taking their assets away from actively managed funds to passively managed funds. And Jack Bogle was at the center of that revolution. Now, by managing index funds, you're not going to make a ton of money because it becomes a back office function and the fees are incredibly low. And on top of that, he set his company up as a mutual company. So it's essentially a not-for-profit where he recycles the profits to, like he shares the profits. And because there's no ownership of the company, the owners of the company are the customers. So they get the profits, which effectively reduce their fees, right? And by doing that and by making Vanguard so successful, he's put downward pressure on fees on the entire industry. It's created an enormous amount of social value in the process. But I would say, so Jack Bogle is a role model. It's a little hard to relate to Jack Bogle because what he did was so extraordinary and he's triggered a revolution and it's pretty extreme. So let me mention someone who did something interesting but more pedestrian. And I'll say that I was particularly keen to find examples in the hedge fund industry because that's the universe I live in. And I went around and tried to find examples of hedge fund managers who are particularly good at serving their customers and show in some ways virtue in doing that by balancing their own interests with the interests of their customers. And so I went to the two main prime brokerage, or sorry, not the main, the leading prime brokerages in New York City. So prime brokerage units of investment banks are the part of investment banks that cater to the needs of hedge funds, right? So if you go to the top two, they have an incredible vantage point on the entire industry because they see a lot of what's happening. And I sat down with them and I asked them, can you point me to fiduciary leaders amongst hedge funds? Because I want to study them, I want to analyze them, and I want to learn from them. And both of them drew absolute blanks. They could not think of any hedge fund in the industry that they would think of as fiduciary leaders. And that, that made sense to me because when I think of our, hedge funds, there's herd-like mentality. And everybody does the same thing. And you have these standard terms. And these standard terms, frankly, are very beneficial to the hedge funds. And so I finally found a guy who did things differently. And so Andy Okun, he runs a relative ARB fund, which he co-founded with another guy, Steve Mazdalewski. Both of them came out of a legendary ARB group at Salomon Brothers. So it was in the heyday of Salomon Brothers in the 1980s. This was the highest performing group. And they decided that it was a little bit too much of a sharp-elbowed culture. So they left to create their own investment vehicle, a hedge fund. But instead of doing what everyone else does, which is you typically go to the law firms that cater to hedge funds, right? So the Schulte, Roth, right? Or like there are like a handful of law firms. They have boilerplate agreements that you take, and those are the ones that you see that limited partners are going to go through and sign. And they went through it and they thought, this is not right. It doesn't feel right. It's very asymmetric. So they decided to start with a blank sheet of paper, and based on first principles, they wrote their terms down in ways that they thought would serve their customers well. And when you look at their terms, they tend to be different. And you know, I won't go through them, and certainly we can, you know, delve into the details in the Q&A. I will mention one that stood out to me, which is, you know, so the hedge fund revenue model is typically you get a cut of the assets under management as a management fee on an annual basis. And that's really meant just to pay for your rent and the salaries and no more than that. And then if you generate a profit, you get to keep 20% of your profits or whatever your incentive fee is. So, you know, on average, probably more like 15% now for the industry. And they decided there's something off about that formula, because in good years, we get to keep, say, 15% of the profits. But in bad years, we don't return that money. It's just that we essentially give the investor. So if we lose money, so let's say you make money for a number of years and you get your incentive fees, and then the following year you lose a lot of money, you don't return any of the capital that you've made, any of the money that you've made as incentive fee in previous years. What you do is you give the client an IOU and say, I'm not going to take any incentive fee until I go back to my high water mark. And at that point, I'll be able to generate incentive fees. Now, in practice, what happens is that if you make losses, limited partners are going to leave. And when they leave, typically, they would have paid you a lot more incentive fees over the history of their tenure of the fund than they should have, right? So they decided, so Andy Okun decided, we're not going to do it that way. We're going to make it symmetric. When I generate gains, when the fund generates gains, we're going to keep the incentive fees, so to say 15%. When we lose money, we'll give you back 15%. We're going to make it symmetric. And that's pretty striking, right? And so, but there are many other things that he did that really resonated with me, because it showed true fiduciary leadership. Now, all of this sounds pedestrian, right? Because I mean, we're talking about terms. There's nothing really, you know, I mean, like I talked about like inspiring behavior, and we're deep in the weeds of the fine print. But here's why it matters. It matters because in finance, a lot of the deviation from serving your customers faithfully happens in the fine print. And to the extent that you treat that the way you should, and show the kind of respect that you should to your customers, and are thoughtful about it, then it makes a big difference, right? And the other point is that finance is pervasive. So these are going to have massive effects, whether, you know, I'm talking about a hedge fund, but imagine the fine print in a credit card. We've seen a lot of research showing that the fine print in credit cards is massively skewed towards the credit card providers in ways that seem egregious, right? So that's why it matters, even though on the surface it sounds pedestrian. Okay, let me move on to the next three pillars. I'll go faster through those. The second one is, to me, the one that the industry needs to be a lot more thoughtful about, which is that as a finance professional, you can serve your customer really well and thus be successful, because that's going to be your metric for success, and yet do so by extracting value from the rest of society. And that's a problem, right? So I'll give you an example. You know, the proverbial example is the company that pollutes, right? So in the US, not everywhere in the world, but in the US, it's still the case that you can pollute and you're not necessarily going to be fined for it. So there's an element of, you could be a company that generates excess returns because you haven't invested in machinery that is environmentally friendly, for instance. And so you're generating high returns, high private returns, but then the social costs of your pollution is borne by the local community. So it's socialized, right? And there's something unfair about this. And if you're an investment firm and you invest in that firm, well, you're riding on these coattails and you're benefiting from that asymmetry as well, right? So that's, that's one example. I'll give you a more extreme example. And I don't want to suggest that the environmental examples are not extreme, but I'll give you one extreme example is in the late 1990s and early 2000s, the governments of Greece and Italy had a problem in that their government debt was rising above the threshold that were mandated as maximum by the European Union. And so what they did is they hired a couple of investment banks. So they hired Goldman Sachs and JP Morgan to help them. And Goldman Sachs and JP Morgan were incredibly effective at helping them obfuscate their level of debt. They essentially masked how indebted they were so that in the official statistics, it didn't look like they were above the threshold. And if you step back from this, you would say, okay, on one hand, Goldman Sachs and JP Morgan serve their customers really well because that's what their customers were asking them to do. And they got paid, I'm sure, a ton of money for it because they happen to have the very rare mix of incredibly deep understanding of financial engineering and insights into regulations, right? And so as a result, from their perspective, it was all good. Now, if you step back from this, you look at this, it's hard to imagine that the investment banks were really serving society. They were serving their customers in a narrow way, but it's hard to imagine that they were not extracting value from the rest of society by allowing these countries to be more indebted than they should be. And on top of that, for the rest of the world not to know that they were as indebted as they were. And you fast forward 2011, we have a Eurozone crisis that's really driven by excess debt in the system. This is not to say that Goldman Sachs and JP Morgan are responsible for it at all. And in fact, it's not to say that these two investment banks are any worse than any other investment banks. It's really more as a proxy for investment banks. But the point is that you can imagine all sorts of scenarios where you can be really successful and yet extract value from society. And this is where there's a really exciting development that's taking place in the investment world, which is, I'm sure many of you have heard about it, which is this approach of embedded ESG into your investment process, right? So embedding environmental, social, and governance factors into your investment process. And a lot of that is about being more mindful of your impact and the impact of the companies you invest in on stakeholders outside of the shareholders and the customers in this case. So that's, I think, an important pillar and one that bears a lot more reflection. And in fact, the ESG world on the investment side is spending an enormous amount of time trying to figure out what's the right way to define social value in this case and how to standardize that. Let me move on to the third pillar, which is, so now the third pillar is lower in that pyramid, and it's really looking inside the organization, looking inside your firm, and it's about treating your colleagues and your employees with dignity, with fairness, and promoting diversity within the firm, within the industry. This, I would argue, as a pillar is less important than the others, simply because you're talking about a smaller constituency, right? We're talking about like the small group of employees. Now, of course, if you work at JP Morgan, it's a very large group of colleagues, but in a firm like mine, it's 9 of us, smaller, right? And here, the key is to, I mean, it's really like bring up your humanistic values, essentially. And there are all sorts of examples of people that are interesting role models in this respect. I write about people like John Montgomery, who created Bridgeway Capital based in Houston. And he, for instance, decided that there is compensation for the top of the pyramid, whether it's in financial services or outside of financial services, has become unhinged, certainly in the United States. And so he wanted to make a statement. And so he said, in his investment firm, the ratio of compensation between the highest paid partner and the lowest paid individual is capped at 7 times, right? So that's an example. You have Hellman. So Hellman founded Hellman and Friedman, which is one of the preeminent private equity funds. And this was another interesting one because he creates a very, very successful private equity firm. And then as he's about to retire, he does something unusual, which is he decides not to cash out. He has a certain percentage ownership of the firm, but instead of selling that ownership at a huge premium because he's created so much value, he said, I'm going to pay it forward. I'm actually going to sell it back to my existing partners at book value at a very low price, essentially just to show that I'm reinvesting in the firm for future generations with a view that it's going to motivate those who are coming behind me. Natasha Lamb is a very interesting example of a woman who is a fund manager based in North Carolina, and she decided that gender equity could use some help in financial services. Since 2014, she has initiated something like 25 shareholder proposals, and all she's asking is for all these financial service firms, and she's gone beyond financial service firms. She's also gone to I mean, these are all listed companies, so some of them are not in the financial sector, but she's asking them to disclose and publish their gender equity gap or gender, yeah, so the gap in gender pay. And eventually one of the banks decided to yield to the pressure because after a few years of initiating these proposals, there was enough pressure, and Citigroup decided to publish them. What happens is 2 things. One is that once a large firm decides to publish that, most of their peers are going to publish it as well because it's putting pressure on all these peers. 2, before they publish these numbers, they are embarrassed to publish terrible numbers. We know the industry numbers are terrible. So they start to hustle to improve these numbers, right? So they launch all sorts of internal initiatives and so on because now they want to show better numbers, and they'll publish their numbers and they'll try to improve on these numbers year after year because just the mere fact that they're publishing them makes a difference. Right, so these are small things that can really truly be effective over time. And then, so that's for the 3rd pillar. And then let me end on the final pillar, which I call citizenship. In some ways, that's the one I find most interesting intellectually. And it's this idea that in the finance industry, we're lucky in the sense that the skill set that we develop tends to be a versatile skill set. It's one that can be applied across many different activities. And so what I wanted to focus on here are ways in which thoughtful individuals in the industry apply their skill set, their finance skill set, to pursue social goals outside of their job, right? And sometimes it's in parallel to their main professional responsibility. And sometimes it's after they leave the industry to do something else, right? So there, of course, there are many examples of, say, finance professionals who left to become public servants. there are many examples of individuals who've done this in parallel to their professional activities. So David Webb is a fascinating character that I've interviewed and followed for years now. He's an investment professional focusing on small caps, a British guy who's based in Hong Kong. And he's used this skill set to be a governance activist. He's an agitator. He created a website in Hong Kong that calls out all sorts of governance issues. And it's often like egregious breaches in minority shareholder rights. It's egregious breaches in just citizen rights. And when there are breaches to Hong Kong rule. And he has had an incredible impact over the last 25 years. But the thing that's interesting is that you can see how he uses his finance skills to put together his cases. He will come out, he'll spend months on a case, and then he'll publish it for free, just put it on his website. He doesn't have a financial incentive. These things are typically completely disassociated with his own investments. And he's had incredible impact. And I'll finish this by leaving you with one more example, which is one I like, particularly because it's a younger person. And it goes to show that, and particularly for all of you who are at a very young age and in school, I think it's an interesting one. I met this woman, Erin Goddard, and I think I met her 3 years ago when she was 28. She had spent 5 years as an accountant at Ernst & Young in Toronto. And she took a summer off to Ernst & Young's credit that was part of an internal program that they have to go and volunteer in Kigali in Rwanda for a summer. And she came back with this insight, which is that when in a developing economy, like Rwanda, there's a huge dearth of accounting skill set. There's just like very few CPAs, very few accountants. But it's an enormous obstacle to economic development. Why? Because all of their corporations, well, I shouldn't say all, but many of their corporations and many of their not-for-profits are run a little bit in the dark because they don't have that accounting skill set. And as a result, it's impossible to manage an organization without having a firm handle on numbers. And she decided to do something about it. So she left Ernst & Young, went back to Rwanda. She brought with her a colleague from Ernst & Young, and they created an accounting academy. And they've been training Rwandan individuals who typically have just graduated from college. And they spend, I think it's 13 weeks in training, after which they're truly job ready to jump into an organization and do accounting work. They're not CPAs, but they're job ready and they can make a big difference. And not only in her own way, she is helping in a narrow way, but very potent way, the corporate sector and thus the economy. And she's also like setting people up for success, right? And enabling them to access middle class. So these are the 4 pillars. I would say in closing, none of these people are heroes. And some of them come close to it. And particularly I write about whistleblowers, for instance, and those come close to it. But for the most part, like what they do is pedestrian. It's not, and it can't compare to the nurses who've taken care of patients through the pandemic, for instance, or frontline workers who've showed up at work doggedly every day, right, to serve their communities, despite the risk of the virus. But they make a difference because finance is so pervasive, and there's been that slight sliding of finance over the years, and so they really merit attention, and we can learn from them in ways that I think are very helpful. So let me pause here and let you take it from there with questions and comments and anything.
Well, that was an incredible tour de force through a very large, area. You covered so many things that I do not know even where to start our discussion. But let me start with your observation at the very beginning, which I think is an extremely important observation for us as educators, because I do find, as you mentioned, that young people and our students are sometimes a little hesitant or afraid to enter the finance industry, even though they would like to very much, because they are asking themselves, is this the kind of place, is this the kind of industry that I really want to spend my life? As a matter of fact, I know I have students in my class who are very disturbed by what happened during the 2008-2009 financial crisis, and the accounts that we read, stories that we read about what happened in that very massive, global sort of meltdown in the finance industry. And it's very ironic, as you also said, because both you and I, we were attracted to the finance industry and the study of finance, because finance is behind growth. Finance is needed for R&D. Finance is needed for innovation. There are many good things and benefits that the finance industry, provides. And you touched upon what are some of the specific reasons, almost like structural factors. And I was taking notes, the sort of fault lines that we have in the industry, why we find ourselves where we do. But let's also address some of the issues that we typically have learned from our study of economics, that if a particular factor or characteristic is creating problem, if somebody is losing reputation, if the erosion of trust is creating loss of value, then there will be some rectification of that. There are sort of forces, market forces that will bring us back to what is a better situation. So, in 2008, 2009, the example that you started with, it led to massive erosion of trust in the entire finance industry, banking industry. And why is it that this trust has not been recovered? What is it? You talked about the sort of structural factors and fault lines. How can we in the finance who are in the industry in some small ways, what can we say and what can we do to get back the trust? As you said, back in the 1970s, 80s, and 90s, the finance industry was looked at and looked upon in a very different way compared to what started happening after that. So what can we do to get back what is lacking? And is finance industry the only industry that is suffering from this? Can we learn from some other industries that maybe have the same kind of structural fault lines and structural factors to get back our lost reputation?
Yeah, I mean, it's interesting because, I mean, as you mentioned, there was a huge loss of confidence after the global financial crisis, and you would have expected the industry to change dramatically after that. And so what has changed since? We have more regulations. So Dodd-Frank came along, right? And so it's actually mitigated some conflicts of interest, not many of them, but some of them. So for instance, if you look at the set of activities that banks or investment banks are involved in, one that they're not as nearly involved in is principal investing, right? And that was an issue because, for instance, whether it was Goldman Sachs or Morgan Stanley, it got to the point where the vast majority of their profit came from principal investing as opposed to customer services. And there was an inherent conflict of interest there. And so if you look at the Abacus security, that's a clear example of it, for instance, where they offered securities to their customers that seemingly were not in the interest of these customers, while on the principal side, they were taking positions that were completely at odds with the actual products that were actually the opposite direction of the products they were selling to their own customers. So there's some regulation that's affected that, but there are, it's almost like we have a short-term memory in the finance industry, and there's a period of time during which I think the industry was sheepish because it was so clearly at the center of the global financial crisis. And after that, you tend to forget and you tend to refocus on the opportunities in front of you. And to the extent that there is the ability to be aggressive and to leverage and to go out and swing hard, then you go back to where you were. And so that's why, for instance, I mean, I don't want to pick on Goldman Sachs by any means, and this is more of a proxy for any other firm. But you have the Abacus scandal in 2007, lots of attention, congressional hearings, a huge fine. And then a few years later, you have the 1MDB scandal in Asia. And it sounds like, it repeats itself. And, if you pick up the paper any day, like yesterday, if you looked at the Financial Times, there was a story around Deutsche Bank selling structured products to small companies in Europe that were deemed to be toxic. And these are exactly the same issues that we were talking about in 2007, 2008. And we're like, and this was like more than 10 years later, and you would have thought that we would have moved along. And same with, and it's not just investment banking. You look at, for instance, accounting firms make the same mistakes, right? Wirecard is a perfect example of a scandal in Germany where you see the same patterns that have happened over and over again since Enron and WorldCom, where the accounting firms get too cozy with their clients and don't kind of raise a red flag when there is clearly an enormous amount of smoke around accounting irregularities. So my sense is that, so why is that the case? I think it's still the case that there is, on one hand, we could regulate the industry better. On the other hand, I think we are incredibly poorly equipped at dealing with our own cognitive biases. And that's the area that I think is underexplored in the industry, and where there could be a lot of research and a lot of new ways to tackle that, which is, how do you bring to the attention of any professional the fact that their decision is not is one that's going to have negative consequences on other stakeholders, right? That's the piece that I think bears some focus on. And my view is that we should bring behavioral economists and psychologists into investment banks and hedge funds and insurance companies and accounting firms to try to allow people to be more mindful of their own decisions. And one thing that I'm looking to explore as a next step from this book potentially is, could we use checklists? Checklists have been a very, very beneficial tool, despite the fact that they seem incredibly simplistic, but they've been incredibly helpful in surgery and in the medical field. And I'm sure, many of you are going to be aware of the work that Atul Gawande did some 10 years ago, I think. And I suspect that we could use something like this in the financial industry, which is a checklist of, okay, so you made this important decision as a group, and the group gets together and actually writes down, okay, what's the impact on this stakeholder? What's the impact on that other stakeholder? What's going to be the impact? And I think the mere fact that you would think about it explicitly and potentially document it could change behavior in a positive way. But I think you're right that it doesn't feel like we've made a ton of progress over the past decade or so.
you made a comment which sort of cuts to the very core of characteristic of the finance industry and financial markets when you talked about asymmetric information. If we look at the complexity of the finance industry, we have regulators, we have the Securities and Exchange Commission that wants complete disclosure to make it more of a level playing field. We have all kinds of gatekeepers, and all of that fundamentally arising from this problem of asymmetric information. So that and the complexity of some of the tasks in finance industry seem to me to be good examples of what you said about the structural factors. So, I mean, you may have had other things in mind, but I see those as very fundamental in terms of the characteristic of the finance industry. What can be done beyond what is already been done in terms of the regulation, Securities and Exchange Commission, everything that the gatekeepers are trying to do is to address this problem of asymmetric information.
Yeah.
What else? Yeah, go ahead.
What else can be done? I think, frankly, customer education is an important one, because a lot of the issue that we've seen in terms of the evolution of the industry and the development of new products over the last 10, 20 years, the problem is that a lot of the services have become more complex. So that's on one hand. On the other hand, what we have found is that almost all of the complexity tends to be to the benefit of the service provider and not the customer. And that's a problem. And so it's almost, there should be a rule of thumb in the industry, if you're a customer, that the simplest products tend to be the ones that are most helpful to you. So it's almost like educational, and sometimes these ideas take a lot of time to propagate. And a great example, for instance, is index funds, right? Index funds is like this enigma in my mind, because we have known since the early 1970s that it's much, much better for the vast majority of the population to put their savings into index funds. And yet it took 4 decades for this idea to really seep through the mindset of retail investors. Why did it take 4 decades? Because there's nothing new that we know today that we didn't know in 1974. But there are a lot of forces at work that are resistant to that. Not unlike, frankly, we knew for decades that smoking was bad for you, but it took decades for people to wean themselves off of smoking in the U.S., right? And so there's something curious about the amount of time it takes and a lot of it is education, I think, that could be very helpful. Obviously, in addition to regulation. And the other piece that's really interesting that really didn't exist much 10 years ago is shareholder activism. And there are
Right.
2 types of shareholder activism. There's this type of shareholder activism, which is simply to try to help yourself generate better returns and in the process, hopefully help the company become a better company. But there's also shareholder activism now that's really driven by not-for-profits and by social causes, where not-for-profits will literally take shares in the list of companies in the company just to initiate a shareholder proposal, and they will be not economically or financially driven. They just want to impact the behavior of these firms. And that's going to be a potent force, I think, going forward.
Will you take 1 or 2 more questions?
Sure.
I know it's getting late for you.
Course.
So we have a question from Jacob Cohen, who's saying, who are the role models of which college students should particularly look up to in terms of achieving social value within the minor influence that we have currently?
Within the what?
Within the minor influence that we have currently. But I read this question basically as asking, who are the role models to look up to in terms of achieving social value?
Right. So, yeah, I mean, so, you know, I document about 60 of them. So in addition to the ones I mentioned here, I would also look at young entrepreneurs who are actually bring to market new products and new services that are streamlined, simpler, and that are clearly benefiting society. So I'll mention one, you know, Carlos Garcia. He created FinHabits. And I should say I'm conflicted here because I actually invested in this company. I liked it so much. But you know, he's basically created a robo-advisor, which is nudging investors to put aside capital for their retirement. But he's specifically targeting a part of the population that is largely unbanked and certainly not saving anything for their retirement, which is the low-income Hispanic community. And it's an interesting one because this is part of the population that no financial institution has really touched, and where their behavior is not helpful to their own future. And so he created all these webinars to try to explain what they should be doing. And he's offering these incredibly low-cost products. I mean, they're all index funds to get them to do the right thing for themselves. And so you know, these young entrepreneurs, I think, are interesting to study. And you know, it goes to all the way to you know, folks like Vincent May started a new type of private equity fund where he tried to address all the challenges and issues of the private equity and the conflicts of interest within the private equity industry, having run a typical private equity fund for years. And he set it up in a way that's completely different from anything that exists, which means like it actually has no maturity, for instance, there. And he sets a budget that a corporation, it's essentially a corporation, and the budget is voted on every year. So he can't make a profit out of the management fees. And so all sorts of things that address these issues. So there are many role models out there, and I don't know which ones, you know, I mean, there are too many for me to go through. And you can go to my website at Princeton, my Princeton website. If you Google my name, that will be the first website. And under the book tab, there will be some links to chapters of the book. Of course, you know, I encourage you to get the book, but you don't have to get the book. A lot of it is free. And you can find quite a few role models in there, including Alexander Hamilton as a wonderful role model as well.
Thank you so much, Jesse. I do not know how to thank you enough. We definitely look forward to your second lecture, which would be on March 29th. Again, this was an excellent description of of what young people should look up to. Not just young people. I think all of us should actually you know, look up to. So again, thanks very much. We will not hold you back. Thanks everybody for joining, and good night for now.
Great, and thanks so much for having me. I enjoyed doing this, and I look forward to the next one.
Thank you so much.